Hi, everyone. And once again, an official welcome from my side to the Professional Investor Business Plan Live Trading Series, Part 5. We're going to continue straight where we left off last time, while starting to talk about our trading rules. We've talked about generally what makes markets move. We touched on location as well as direction. We talked about the Campos indicators. We've started talking about the Campos indicators, and we got to the Campos COT index and the COT report in general, and we ended it with the commercials. What's left here is the speculators, of course, the retailers, as well as the non-commercials. And then after we can go into the true seasonality as well as the valuation, which then concluded is going to be 3 of all of our fundamental setup tools. So we're going to have a technical setup in the market, location and direction, and we're going to look at the fundamental setup. Ideally, we always want those 2 to be aligned. As we ended it with the commercials, we concluded that the commercials are the key players when it comes to our finite markets, and that they are a group of traders that we definitely want to look at, we want to understand them, and we want to ideally align our analysis. We want to align what we want to do, whether we want to buy or sell, with whatever they are doing. Now, what about the speculators? Well, we know that the commercials are the most consistent in the game. They're not always right, but most of the time they're pretty dang right. And so the speculators is going to be the other extreme of the picture. What do I mean by the speculators? The speculators, they are basically the retailers. Now, the retailers, you may say, how do we see their position size in the market? Well, technically we don't, because we would also be retailers, right? We would be defined as retailers because of our, in parentheses or in brackets, small position sizes. And none of us have ever probably reported their position size, right? When you register and apply for a broker, then they will ask you all these kinds of questions. And at the end of the day, they will then determine whether you're a professional player in a game or whether you are a non-professional player in a game. Most of us are, well, all of us are non-professional players in the game. That means we don't have to report what we're doing. So how do they know what we're doing or what the public is doing? Well, what they're doing basically is they're counting all the contracts every week that are traded on these central exchanges. And then they will have the reportable contracts as well as the non-reportables. They get the non-reportables and just taking away the reportables from the total sum. And basically then what is left off is the ones that don't have to report, right? And that kind of understanding of the COT report is going to be important as we talk about the retailers as well, because actually some of the retailers are not actually retailers. They are professionals hidden within the non-reportables just because of their position size being not big enough for them to be rated and defined as commercials. So in short though, and as we can sum this up and put this into words nicely here, I've tried to give this my best shot here. And so what I came up with is that the retailers, they're a representation of the public. So the small speculators, you and I, right, we're just trying to make an extra buck in the financial marketplace. Now, you have probably, as well as I have, we've seen estimates from brokers that state that between 80 to 90% of this specific group are net losers. And so the problem is that we are hardwired to buy at market highs and to sell at market lows. So our instinctual buying and selling behavior is to buy after a large rally and to sell after a large decline. Now, what this specific index should help us to do is kind of reprogram ourselves to avoid buying when the retailers as a whole are buying, and to avoid selling when they are selling as a whole. In fact, we must learn to do the exact opposite of this specific group. When they're bearish, we look to go long, and when they're bullish, we look to go short. Not always, right? Not always, and mostly only when they're aligned with, when this index would be aligned with the commercials. But this gives us a pretty good idea of what the general public is thinking about a market at a moment. And if we catch ourselves having the same belief system at the moment, we must challenge that belief system, right? And so, for example, if for the equity indices, we saw on Nasdaq last week that the retailers were bearish to an extent that they have not been for years. Actually, in an entire decade, the last time they were that bearish was in 2012. So if the retailers are bearish to an extent that they have not been in a decade, then we must challenge that belief, even if we are bearish at the moment because of all the bad news that are going on at the moment and the bad things that are happening around the world. We must challenge that belief and be factual traders, right? Factual traders. We need to look at the charts and the fundamentals within the charts, and not what is going on around us. So that should help us just in a general sense as well. I can also make a quick example on Palladium, as we started that last time on the commercials, with also the level that we bought down here. And so when we talked about the commercials back then, we said that the commercials were at an all-time high accumulation at that stage, right? Never in history have they been accumulating that much. And so that was bullish. As we look at the retailers down here, the red line, if I'm comparing their exposure, their net exposure to the past, then they were at a multi-year low, close to a multi-year low, definitely a multi-year low, close to a 2 and a 3-year low. So they were extremely bearish. And so again, they were doing the exact opposite of what they should have been doing, right? They should have bought like us, but they were bearish. And so most of the time for most markets, you will see that the speculators, the small public, their instinctive buying and selling behavior is, and the way how they're hardwired is just designed for them to be consistently wrong in the marketplace. And whenever they have a very high exposure, like here, for example, we can see that the market is destined to decline. Or whenever they're super high here, the markets are destined to decline, right? And so whenever they have an extreme exposure as well, and that especially that overlaps with the commercials, that is a sign for us, almost like a COT enhancer. The commercials by themselves is good enough for me most of the time, but if I see that someone is trapped on the other side, that's kind of a fundamental enhancer, if you will. Would I act on the retailers individually, isolated, without the commercials? No, I wouldn't, right? So again, the retailers, they're just giving us a little bit of added value, if you will, and they're supposed to challenge our belief system, right? Whenever we catch ourselves having the same belief system as the retailers at the moment, then we must begin to challenge that belief system. And and when they're aligned with the picture that we want to see on the commercials, then it's a home run for us, basically, right? The potential for a home run trade. Now, how can we make this easier? Of course, we can make this easier with our Campus COT indices, or our Campus COT index. Here we'll be looking at 3-year cycle periods for the long-term picture that we use for anticipatory trend changes, and we have a 6-month cycle period for just a normal trend trade. these cycle periods are exactly the same as we use for the commercials. Also 3 years on the commercials is also 3 years for the long end, and 6 months for the short end. A bearish picture is if the retailer index goes above the 80 percentile range, the green line. That is bearish for us because these guys will be bullish. Remember, we want to do the opposite. Another bearish picture is if the index shows a 1 year or multi-year high plus the index above the 40 percentile range. And a bullish is going to be exactly the opposite. If the index is below the 20 percentile range, the red line, and bullish is also if the index shows a 1 year multi-year low with the index below the 60 percentile range. And so what we can nicely see from our Campus Equity Index is exactly that picture, right? Whenever these two are on the opposite sides, then we want to really look at what's happening in this market. We really want to pay attention to that. Commercials buying, retailers selling. Commercials buying, retailers selling, right? This is our index. This would put this nicely into an index. Whatever you see in those two charts here may not be very user-friendly. And so what we can do is easily, for our eyes, just look at the index. Okay, at the moment as well on the short end, may be interesting to look for shorting opportunities on gold, right? But more about that on a DMO. It's not just enough to look at the COT here. We also need to look at how the technicals align with that. And so we also have the short-term 6-month cycle periods. This is what we just looked at. Bearish if the index is above 80 percentile range, the green line, and bullish if the index is below 20 percentile range. The index that we have created is here also based on the net positioning. So it is, again, advisable to understand the mechanics that underlies all of that, which are the net position, which is the net positions report. The index can only go from 0 to 100, right? And we take basically the minus 20 and the plus 80% range. We take that as extremes. However, if an index is ever showing 100 or if this is ever showing 100 here, for example, 100 or 0, then obviously you would be seeing something within the net positioning report that you don't see here, right? Because then it would be even a further extreme. So the index takes everything between 0 and puts everything into perspective of what's happening right now. And as an index works, it puts it into numbers of 0 to 100. That's just how it works. I just decided that the 80 percentile range and the 20 percentile range are meaningful. That doesn't mean that the 75% and the 15 or the 25 percentile range are not meaningful, right? So take these percentages with a grain of salt, because these are just numbers I invented. I just said, I just divided this index then into 5 groups, and then I said 80 is the extreme and 20 is the extreme. I could have also said 85 is the extreme and 15 is the extreme, or I could have said 75 is the extreme and 25 is the extreme. So when we get close to that line, those lines, it is already starting to be picturing whether we want to be bullish or bearish in that case. What's our expectations here for the retailers? Same as with the commercials, this is a fundamental setup tool. It's not a timing tool. It can be in extremes for very long times until price finally starts to move. And then when it starts to move, it can abandon the extremes rather quickly. And so the retailers are not always wrong, but they have the worst track record in the game. Okay, so they're the most consistent loser. For some assets, though, that is very important. For some assets like livestock markets, the retailers sometimes track the commercials. That is because either very few retailers trade these markets, and or the ones that are listed as retailers are actually commercials, but they're kind of hiding as retailers because their position sizes are not large enough to be categorized as commercials. So we always need to keep that in the back of our minds as well. And this is something that we came back to in the beginning. How are the retailers really made up within this report? Well, they're taking the total contract sizes and they're taking away the reportables. They end up with the non-reportables, and then the non-reportables would be the public, right? And some of those are just people in the game that know what they're doing, and they may be commercials, but their position sizes would be rather small. The non-commercials are large players like the commercials. And in fact, they are the second, most of the time, they're the second largest people in the game. The commercials, most of the time, they're the biggest. The non-commercials, for some markets, they can be even bigger than the commercials. But for most finite markets, they're just a little bit smaller. How do I know that? Well, if you were to study the COT net positions and their total position sizes, sometimes not the net positioning, but their total positions in the market, then you would see that the commercials are the biggest players in the game because they have overall the most contracts. And so here, right, if you look at the net positioning, it would be a little bit misleading because you would basically say, well, look at the retailers, they have 835 contracts on the table, and look at how much the commercials and the non-commercials have on the table. The non-commercials only minus 272 and the commercials only minus 563 contracts. Well, the retailers are much bigger than the commercials and the non-commercials, almost put together, right? And so that is very misleading because net positions means we're taking all the longs and we're taking away all the shorts, and we end up with a net positioning. If you look at the retailers range, then you know what I'm saying. Basically, the retailers range is from 3,000 contracts all the way down to minus 700 contracts. The commercials range goes to all the way to minus 32,356,000 contracts. And their range goes to 29,500 and 5,000 contracts. So that is exactly what I've been saying. The commercials are just a little bit bigger than the non-commercials, and the retailers are the smallest group in the game. They have to be, of course. And so the non-commercials, they are also large traders, but they are not commercials. They're not the users and producers. They are just large pools of money. Okay. And so they would represent large funds and other large traders. And this group of traders makes money in a very different way as opposed to the commercials. They act very differently. And that is important to understand for us to make sense of what the COT report at the end of the day displays. The commercials are kind of like us, but the non-commercials are also kind of like us. Let me explain. The commercials, they buy low and they sell high, right? They will buy into weakness and they will sell into strength. The non-commercials, they buy into strength and they sell into weakness. So they are basically trend followers. They make money by following the trend. And so that is because the non-commercials are speculators. The commercials are not speculators. The commercials are not speculators because they don't say tomorrow, oh, let's go buy accumulate Palladium because we want to make money in the market. No, they want to accumulate the real product, millions of dollars of real product, probably even more than what they would need, right? And so what they do is they facilitate their business activities through that market. So they are hedging constantly. The non-commercials, they're not hedging, they're not dealing with the real product, they're just in the game for the speculation game, right? They would be saying, oh, Palladium is going to rally, I want to buy. And of course, if you're a speculator, like we are at the end of the day as well, then you want to buy with strong existing trends, because we know that trends are meaningful in the market. And so these people, what they will do is they will buy the strongest trends in the market, and the bigger a trend, the more they will buy. This means, though, that the more a market rallies, for example, the more contracts that this group is going to add to the table, to their original position. And so that is also because they're if they're managing money, they have to just deploy cash constantly in the financial markets, right? They cannot be sitting on idle cash. They just have to deploy that constantly in the market. Every week, in and out, they have to deploy capital. And the thing about them following trends is that eventually, right? Eventually, when they have a very high commitment in the market, then it means that they have nothing else left to put in the market. So if they have nothing else left to put in the market, then it means that the direction of this market may be changing. Okay. And then, so what we will then of course see is a trend change occurring. And so we can conclude with all of that is that when the non-commercials are heavy buyers, we look to sell. We do the exact opposite, kind of like with the retailers. And when they're heavy sellers, we look to buy. And so you can also see that from this here as well. When we bought Palladium, the commercials were accumulating and the non-commercials were short. It doesn't mean that the non-commercials at this point that they are wrong. It just means that at this point, with that downtrend here, they had eventually deployed so much capital, so many contracts, more than they have ever deployed on the short side, ever, right? That just there is nothing else left for them to deploy. And if they are the ones that will move existing trends within the existing direction, if they're those ones, right? So we've got the trend changers, the commercials, and we've got the ones that kind of push the trend along. If they have a contract size on the table that is an extreme to an extent where they may have fired all their firepower, it means there's no one left to enforce that existing trend. And so as we look at this within an interplay of the commercials, if then the commercials and the non-commercials are within the same extremes, then we can almost bet on that trend change eventually occurring, right? Because the commercials will have an easier game changing the market if there's no one on the other side trying to push that lower with the trend. And so eventually all of those are then going to flip-flop into the other side, and you see that trend change. And so Palladium is just a very good example, because all of these three were actually at interplay. The commercials accumulating, the non-commercials at heavy sellers at an all-time extreme, and the retailers at a multi-year low and also being very bearish. I don't like to say that the commercials are bearish. It's not scientifically correct, but they would We can use that terminology though, just to make our lives a lot easier. But when I say the non-commercials are very bearish, I don't necessarily mean that they're very bearish. It just means that they potentially have fired all their firepower as a whole, and therefore there's no one left to enforce an existing trend, and we can predict with that a trend change. It doesn't mean that they're wrong. It just means they have fired all their firepower, right? And so how can we look at this again in a more in a more digestible and an easier way with our Campos COT index? So here we look at 3-year cycle periods, and for the short end, it's different to what we look at for the commercials and retailers. We actually just look at 15-week cycle periods. And especially for equity indices, that is going to be very helpful. So let's start at the long end. Long end, again, we're bearish if the index is above 80 percentile range. So the green line, kind of like the retailers, we look to do the opposite. We're also bearish if the index shows a 1-year or multi-year high, plus the index above the 40 percentile range. We're bullish if the index is below the 20 percentile range, the red line, and we're bullish if the index shows a 1-year, multi-year low, plus the index below the 60 percentile range. And the short term is going to be interesting for us. And specifically, I like to look at that for equity indices, because equity indices have one of the strongest uptrends, and so the non-commercials would usually be heavy buyers. And so when they are heavy on the sell side, it usually means that market is turning. Why is market turning if they're on the heavy sell side? It's because there's no one else left who's going to put the markets down, right? Because if the market's dropping, anyways, the commercials will be buying with a decline in price, right? And so if they have sold a lot to an extent that would be an extreme in terms of historic extremes, relating that to historic extremes, then they may have fired all their firepower, and then we can start to be bullish because no one else is going to put the markets down with that. And so with the 15-week cycles, we can look at bearish and bullish. Same counts here. We're going to be bullish if the index is above 80 percentile range. And we're going to be bearish if the index is above the 80 percentile range. We're going to be bullish if the index is below the 20 percentile range, the red line. What's our expectations here for the non-commercials? Again, it's a fundamental setup tool. It's not a timing tool. They can be in extremes for a long time until price starts to move, and then all of a sudden it can abandon the area rather quickly. And so the non-commercials are not necessarily wrong. Just because we go against them doesn't mean they're wrong. But what we see is the total amount of contracts in the market, not when they actually started to buy or when they started to sell. And so as they average in over time, we don't really know what their true average is. So they could very well still be making money with that, right? And so what is the interesting observation here, though, is that the understanding that when they have potentially fired all their firepower, because that is the time that they potentially run out of ammo. And when there's no one left to drive the market into the same direction, we want to go the opposite direction. And if that direction is then the direction that the commercials want the market to go, or show the market, predict the markets to go, then we align ourselves with the commercials, against the non-commercials, and against the retailers. However, we could also align ourselves within the 15-week cycle periods, kind of with an existing trend, by just looking at the non-commercials and just buying the dip potentially with equity indices and not really predicting the end of a band or anything like that, right? So again, this tool can be used for both, also anticipatory trade and a trend trade as well. Now, why did I start with the COT index and not the Campos True Seasonality? I think both tools are very unique in what they show us in the marketplace. The COT, in my opinion, is more predictive of a major rally or decline in the future. The Campos true seasonality may tell us when that move could take place, right? So the Campos true seasonality is more of a when kind of tool, as opposed to the COT being what is going to happen. Because at the end of the day, if we come to think about it now on the picture of Palladium, these are all the players in the game. We've got the retailers, the non-reportables, we've got the reportables, the large traders being made up of the commercials and the non-commercials. Whatever we are seeing happening in the chart is the creation of an interplay of those players. So whatever is happening here on those lines is affecting price, right? And so these lines here are important for us because as they interplay with another and with price, they move price. Okay, we don't know when, we don't know for how long, but we know that eventually they will. And so true seasonality asks, in my opinion, a very different question. It doesn't really ask, am I expecting a large rally or am I expecting a large decline just because of a seasonal influence? It's asking, when could I expect that? When is the most, statistically speaking, when is the most accurate time or the best time to be a buyer? And when is the best time to be a seller? As opposed to asking the question, is it a good time to buy at all? Right? It's a very different question, because if it's not a good time to buy at all, COT index, then I'm not potentially even going to look at the true seasonality. Because if the commercials are heavy sellers, and yes, I have now a seasonal influence to the upside, I may not buy just because there's a seasonal influence, because seasonality doesn't drive price. These guys, they drive price, but seasonality doesn't, right? Seasonality just gives us a glimpse of some seasonal influences of what had driven, of what were the timeframes that had heavy influences on price. And so in my opinion, it's not, though, as I'm talking about what is what tool, in my opinion, it's not, there's no right or wrong about those two tools. They have their unique pros and cons. Ideally, we use them in alignment, right? We want to use them in alignment. And so let's talk about the true seasonality first, and then let's talk about that alignment that we want to see within our fundamental setup tools. So we know that, right? We know that a lot of markets show very strong and dominant seasonal time periods, or seasonal patterns, we can call them also. In other words, there are certain times of the year when certain markets are most likely to rally and most likely to decline. Our Campos True Seasonality tool allows us to always project the most up-to-date and relevant future projection of when the next major seasonal lows and highs take place. And so it's important to say that it's always the most up-to-date and relevant future projection, right? It's not a past projection. It's calculating the future low based on the past data points. And that is very important, as the data points will shift in the future depending on what is happening today. And our tool just allows us to have an accurate calculation based on the trading days of the year rather than the calendar year. There have been lots of backtests done that just show there's a better significance and relevance to the buy points and sell points if we take trading days as opposed to calendar days. And we take the real numbers of the real futures data, right? The real underlying central exchange data, which helps us to get A, the most relevant, and B, the most accurate and up-to-date data. And then we can project that into the future, which then gives us future good buy points and future good sell points. And so what we want to do with that is kind of say, okay, is it a fundamental setup tool or is it a timing tool? Well, it's probably a little bit of both. If a finite market has a seasonal influence during a specific time, then, and it's proven that that strong seasonal pattern has been there for 5 years, 10 years, and 15 years. We know it's there kind of every year. It happens, the same thing happens. Then we know that that seasonal influence is there for a reason, for fundamental reasons. While we may not know that fundamental reason of why that seasonal period is there, we could make sense of it. Oftentimes it's just also self-fulfilling prophecy, that just because this has happened in the past, that's what professionals also look at, that was most likely to happen also kind of in the future. But a strong seasonal pattern oftentimes gives us kind of a fundamental glimpse of what's usually happening for that specific finite market over the years. And so that usually, goes, these charts usually, they go with a rhyme, like they have a rhythm, and that rhythm kind of every year is kind of the same oftentimes, right? And what we want to do is we can look at many different kinds of timeframes here, right? We can look at 15, 10, 5. We ideally want to see an overlap on those major seasonal highs and lows when aligning the periods. I just like to start off with 10 because that's kind of the average, that's kind of an in-between here. It's good to see an overlap on the 15 and the 5 year as well. Why is that? That is because if I just take the 5, then I could have 1 year out of those 5 years that will, as an outlier, extremely skew my average at the end of the day. And at the end of the day, seasonality, if you come to think about its mechanics and how it's calculated, it's an average, right? It's an average of the past put into the future, displayed, projected into the future. And so if I just have one bad year, let's say I have one bad year, and the rest of the years, 4 out of 5 were kind of, the markets was rallying 2 or 3%. And then I had one bad year where the market was maybe crashing by 10% because of an outlier year. You would have a 5-year seasonality and an average that's completely skewed. It wouldn't take the real true average. So you would have outliers skewing that picture. If I go to a 10-year, then one bad outlier cannot really skew the picture. If I go to a 15-year, then one bad outlier cannot really skew the picture. The problem though is that the higher I go in the number also, the more, let's say, also skewed the picture may become. It doesn't, because it may not anymore state the most relevant market condition, right? So if I look at the 15-year average, the past 12 years I've been in a bear market. Now I'm in a bull market for the past 2 years and I want to buy. Then the seasonal pattern of what I would see may not be displaying what should happen during a bull phase, right? During a bull market. So it's kind of, it becomes kind of complex to talk about the different years and their pros and cons. And so I usually just like to do the 10-year, start off with that. If you see significant lines, then they usually would also anyways probably show you that on the 5-year and the 15-year probably as well. And so there won't be too much of an off as you go into the 15 or the 5-year. So I like the 10, it just makes life a lot easier. And then looping back on the, whether it's a fundamental setup tool or a timing tool, it's kind of both. Why is it both? Well, it's kind of showing us a fundamental setup in that market, but it's also telling us when to buy or sell, right? When is the best time? And just asking the when question is, we talk about market timing. And it's something that I could never answer by just looking at the COT report, because the COT report can be in extremes for a long time. I don't know the when. They could be there for long. They could be there for a very quick time. I don't know, right? We have no idea. Sometimes they're there for years until the market shifts. And so the seasonality aspect then gives us kind of an idea of when we may then want to trigger that idea of going with the commercials. So it's kind of both. It's a fundamental timing tool. It's a fundamental setup tool, and it's a timing tool, but it's not a timing tool in terms of timing by price with price. That's still technicals. It's kind of asking when. So seasonality, what does it not do? It's not indicative of the amplitude of the move, right? So it doesn't say how massive is that rally going to be in size, or how big of a decline are we going to get. That is information that we could get from the COT report and has been pretty accurate. We can make pretty accurate sense out of that, right? Especially as we, for example, look at all the precious metals. We looked at them in January, December, January, February, the most bullish year for precious metals. You guys know that, right? If you're in the room, you've been with us for more than a few weeks, then you know that December, January, February is the most bullish year for precious metals. We know that because our seasonality tool, right, Campus True Seasonality, gives us a very clear seasonal influence from December, mid-December, best time to get in, always one day before Christmas is the most accurate, because we can see usually it just goes up every day, right? And then that seasonal influence usually on average lasts until the mid of February. So we know that seasonal influence is there for platinum, it's there for palladium, it's there for gold, it's there for silver. I don't have to show you. So we know this is there, but that move is not going to tell us how much of a rally or how much of a decline we're going to get. That we can only make sense of if we look at the COT. And so now if you come to think about it, if the commercials are bullish, if the retailers are bearish, and the non-commercials have fired out of all their firepower, approaching a period where there's a bullish seasonal influence, then dear Lord, this is what we call the all stars align scenario. All that there is left to do is find a way to get into that market that will give us a good risk to reward proposition, meaning risk to reward. That we do with supply and demand, right? Where do we buy? What's the price point that we buy? So COT is asking, do we want to buy? Seasonality is asking, when do we want to buy? If we talk about buying. And then supply and demand is telling us at which price point are we happy to buy, and how do we time that with an adequate risk to reward proposition. In my opinion, ideally we need all. If you ask me to put a focus, if you ask me to prioritize seasonality or COT, I will say COT, right? I'm saying this because that is my approach. I know there's other approaches. They may have a higher focus on seasonality, or will still look at that specific seasonal time period and just be a little more aggressive, kind of like taking a stab. I'm looking really at the alignment as the best kind of trades. And if I don't have the alignment, I will stick to what the COT is telling me, because these guys eventually will drive the markets. Seasonality is also not used to argue trend, and so higher lows or lower highs. Rather, it tells us when are potentially better or best times to be a buyer and potentially better or best times to be a seller in the future. The strongest seasonal periods of the year are found in equity indices and precious metals as per the following. That is has just been my observation in the past years of following the market. I've watched seasonal periods that have that had looked like super strong seasonal periods, and they failed. And I had looked at weak seasonal periods that had worked out pretty well. I had kind of seen it all, but the ones that really have the best consistency, even without the commercials, put everything put aside, just looking at true seasonality, is the October, November buy points in equity indices and the end of December, January buy point in gold and silver. It almost every year produces gains. How big of those gains are produced really depends on the underlying condition of what the COT and other fundamental drivers of the markets may tell us in terms of valuation for equity indices too, which then would be the next topic. So our expectation for seasonality, true seasonality, is that it's not the be all end all. Okay, so that usually markets tend to rally and decline about the same time every year, but not necessarily. Therefore, we'll be using seasonality as an additional layer to get a better understanding of the underlying fundamental condition of the market. Or in other words, we'll be using our Campus True seasonality as a fundamental setup tool, but also as a timing tool. And so that goes back to what we've talked about now for a while, right? And so it's fundamentally very different questions that we're asking when we look at the seasonality tool as opposed to the COT tool. And so, for example, if I'm now going to put at PL here, and I'm going to add the Campus True seasonality here on the same scale. So then what we're going to find is that seasonal rally, that seasonal influence here from platinum from here to here, right? That is displayed within the seasonality, true seasonality. How big of a move we're going to get here is kind of unknown. It's unknown by just looking at the seasonality. However, if we now look at what the commercials are doing and what the non-commercials are doing and what the retailers are doing, it then helps us to get an idea of what the big guys are doing, what are the small guys doing. Therefore, am I expecting a small rally or am I expecting a large rally? When we concluded our precious metal analysis towards the end of last year, we said palladium is going to be the biggest winner of all of them. It's going to be the strongest. Platinum is going to be the second, gold the third, and then silver. Maybe silver the third, and then gold kind of with silver kind of looking similarly as strong in terms of the COT. What really came true was that palladium, as well as, well, palladium especially, because palladium is the only precious metal that made an all-time high. It rallied by more than 100% during that seasonal period. Just looking at seasonality, we could have never said that Palladium is the strongest that year, because technically, actually, it was the also one that was in a downtrend. So technically speaking, it was rather weak. But fundamentally, it was looking the strongest. And so we could predict that. And again, that prediction doesn't always pay off, right? As we can be wrong, also the commercials can be wrong. They're not always right. They're just consistently, they're just the most consistent player in the game. And so we want to follow that. And so as we overlay them, right, then we're saying, first of all, we're saying, do we want to be a buyer? Are we expecting a large rally? Well, if the commercials are at a multi-year highs and the non-commercials are at multi-year lows, and the retailers are also quite bearish, right? Not at multi-year, not at being multi-year bearish, but they were definitely here at that low kind of multi-year bearish. Again, the net positioning is kind of difficult to read, more difficult than our index. But if the retailers are bearish, the non-commercials have fired their firepower, and the commercials are accumulating at multi-year highs, then we want to be a buyer. When do we want to potentially buy? Because they were already heavy buyers here, right? When do we want to buy? Well, we usually want to buy every year at the same time, right? Close towards the end of the year, when the seasonal influences trigger the market the most. And so as we have then that alignment here at that point, at that seasonal low, just a few days before Christmas, we trigger a long. Right now, the problem is we can't just go long, right? And say, well, let's just buy and hope for this to go up. We have to time the markets. And so then how do we time the markets? We just look at supply and demand, right? And we look at rally-based rally. And during that time, we want to be a buyer. And then we had like trap areas in there. And if we don't, then we wait for this to go into weekly reversal. And then we go into our other kind of timing tools with price action and so on, right? And then we try to get into that way. And so that is, with those two tools now, that is how we combine the puzzle pieces, right? Are we expecting a large rally or decline? If so, when is the best time to be a buyer or seller? And if we answer those two questions, at what price point do we buy or sell to get a good risk to reward proposition? And so what we've talked about a lot is, of course, COT. A lot of this is the strongest when it comes to our finite markets, our commodities. I also want to cover our Campus valuation tool, because that becomes kind of more important for me for our infinite markets, especially stocks and equity indices, because then we will have different kinds of fundamental setup tools for stocks, right? We talked about there are different things that move infinite markets than finite markets. And so we want to also look at different things here overall. But what's important, and the last thing, I don't want to go into valuation. I want to go, I'll do that next time. I want to cover something, just one idea really quickly that I am going to cover during the trade log session. And with all of that, right? So if we now come to think about it, and we have if we look at our agenda here at all of these bullet points, we have a setup that we can find in the marketplace, right? We have a technical setup and we have a fundamental setup. And within that fundamental setup as well, there are different ways on how we then combine those setups. So, but in short, we have a technical and a fundamental setup. And later on, we go into market timing. Later on, as we go into logging our trades, basically assessing our performance, there's two ways in which I would like for you to start assessing your trades and also assess your past trades. That is very important. If you already have an existing trade log, then assess your past trades based on these tools as well. I'm going to show you really how to do that at a much later stage. But what's going to be interesting later on, as we have, let's combine the technical setup and the fundamental setup as just the setup. Okay, the setup in the market, the idea. What is the idea? What do we want to do? Are we bullish? Are we bearish? Do we want to be a buyer? Do we want to be a seller? And then there's the market timing element. The problem with being a trader is that even if we have the setup right, we may still be wrong because the market stops us out because our timing was off. However, that is fine for me, right? If you have losers, and most losers come from you being off on your market timing by a little bit, being a little bit too early, being a little bit too aggressive, being, I don't know, just having a level, not looking at a level on top of level, or whatever nuances there is that you can potentially also change in the future, being less aggressive, looking at level on top of levels, being more conservative. If you are just wrong most of the time with market timing, that is the ideal situation where you want to be in. Because when it comes to market timing, there's going to be lots of rights and no wrongs, right? And so there's going to be price action, there's going to be hammer candles, there's going to be just supply and demand, set and forget. There's going to be level on top of level, doing it in different ways. There's going to be trading the higher time frame, the lower time frame, waiting for confirmation, not waiting for confirmation. There's so many different things in how we can approach the market timing, waiting for a trend line breakout, that there's no right or wrong. There's only rights. There's only rights if we have the right setup. Okay. But all market timing tools, we can be so good at market timing. All our market timing tools will fail if we take them outside of the context that we should be taking them with. And so as you assess your trades, what you want to find out is, are you good at setting up at the setup of markets? Do you have an understanding of what you want to do at specific times when you sit in front of, a market, whether you want to be a buyer or a seller? Do you get that right most of the time? If you do, you are at a very good spot, because all you need to get is kind of get to a point where you fine tune your market timing, getting in and out perfectly, which never is kind of perfect, but getting in and out of the market favorably for you. However, if your trade log eventually, assessing of your trades eventually will tell you that, well, it wasn't so much, well, the trade was wrong. In either case, it's going to be wrong, right? Whether your market timing is wrong or the technical or fundamental setup is wrong. Your market, your trade is a loser because completely the setup failed, right? It completely failed and price took you out in an instant. And it's not like it bottomed then the week after or 2 weeks after. It bottomed only like a month later or so, right? Or like 2 months later, or it had a much larger decline still, or a much larger rally in front of it until it then dropped. So there's a certain way how we can assess that. And I think we should be assessing that. We should be assessing whether we are wrong in terms of market timing or whether our setup was just really bad. And I want you to get to a point where just the market timing most of the time is going to be off, because our market timing can always be off. My market timing, when I have a losing trade, Most of the time, it's because my market timing is off. We're all humans. We never really know where the market is going to turn, if that level is going to hold, if price action is going to hold up. They're most likely to hold up when I have the right setup. If I have the wrong setup, all the market timing tools will instantly fail. They will fail me very, very quickly, without doubt. And so usually price doesn't even go to 1-to-1 or 1-to-2. It will just fail and market will continue doing what it's doing. And so we need to identify that, because in my opinion, there's many rights when it comes to market timing, but there's not many rights when it comes to the setup, technical and fundamental. There's not a lot of rights. There's not a lot of times where if I'm really bearish or if I'm really bullish, that I would second another opinion on this, regardless of who says what, right? Regardless of what I read, or regardless of what other person in the room is going to say something. I don't care. If I see a fundamental setup that makes a whole lot of sense, like in December, precious metals are going to rally with the seasonality and the COT in all-time highs and everything. If somebody's telling me that they're bearish as a setup, I would just not listen to that, right? It's like there's not a right and there's not like it may be right or it may be wrong. Of course, that setup could have failed as well, just like any setup can fail, right? But I think as we come to objectively, right, I said it in the beginning, we're gonna have to be factual traders. What does it mean to be factual traders? We have to look at the things that we can analyze objectively, and where, regardless of where you're sitting and when you're looking at this, you and I, as we look at the same things, we have to come to the same conclusion. Only then it's a good setup tool. If both of us look at the same tools and you interpret this as bearish and I interpret this as bullish, it's not an objective tool anymore. It becomes subjective. And so there's not a lot of subjectivity when it comes to the technical setup and the fundamental setup. There's a lot of subjectivity though when it comes to market timing, in my opinion, because some people are more aggressive, some are more conservative, some people use a little bit of gut feeling, some people like to use confirmation, some people like to use a set approach, some people like to use price action trend lines, and so on, right? And so there's a lot of rights, not a lot of rights here. So I wanted to conclude with that, because that is going to be very important in not just obviously talking about what our rules should be, what my trading rules are, what maybe your trading rules are eventually, but also how do these rules also, how do I assess those rules, and what's the importance of those rules, what's the priority of those rules. Also, what I'm telling you is my specific take on the market, right? And it is okay for you to deviate from that. If you find that seasonality is more important for you than COT, then be my guest and put that as a priority one in your trade plan. There's nothing wrong with that, as long as your data suggests that, right? And so there's going to be ways on, again, assessing that, where you're going to you're just going to look at your seasonal setups and you're going to say, well, what are the seasonal setups that failed? What are the seasonal setups that did really well, right? And eventually, if you see that seasonality overall does extremely well for you, regardless of what anything else is saying, any other indicator is saying, then go with that, right? If it's not, though, then you need something else on top. And so again, this is kind of me, right? And it's okay for you to deviate from that. What you shouldn't do is completely, yeah, you need to move within the framework of all of that, right? You still want to look at these things. You don't want to say, no, I don't need them, right? So still within the framework, but you can deviate in terms of what's your priority, what's the importance factor on these, and And so I'm sure there's going to be, at the end of the day, a lot of different trade plans, which also there should be, right? There's not only one ride within that framework. There can be a lot of ways on how this can be used successfully. I'm a big believer in that. If we go and move within the right kind of framework here. All right. So, any questions from your side? I think today we were pretty accurate in terms of timing. Didn't take too much overtime. All great. Anyone else? Any questions? All right. No questions is good for me as well. That means everything was clear. Good stuff. All right, everyone. Thanks for watching and staying until the end. I'll catch you all next week. Happy and safe trading next week. And I hope you all have a good start to the new week. Thanks again and ciao.